and welcome back. Today we're going to take a deep dive into transportation stocks.
Oh, yeah.
And how to maybe, potentially, hopefully navigate them successfully as we head into 2025.
Absolutely.
We found this really interesting article called 3 Dividend Stocks to Scoop Up Now for a Strong 2025.
Yeah.
It really zeroes in on 3 companies, JB Hunt, Knight-Swift, and CSX. The article argues that these companies could be poised not just to, kind of survive whatever craziness might be coming,
Right.
but really capitalize on it.
Absolutely. And I think one of the things that this article really highlights is this craziness, as you put it.
Yeah.
Could very well be the return of Donald Trump
Oh, okay.
and his, shall we say, affinity for tariffs.
Right.
Back in 2018 when he imposed those tariffs,
Oh, yeah.
shipping rates just went through the roof.
They did.
Over 70% they went up.
Wow.
This time around, the article suggests we could see tariffs as high as 20% on all imports.
Really?
And even higher rates for those coming from China.
Okay, so, that's a pretty significant potential impact.
Yeah, absolutely.
And the article suggests that these 3 companies, at least, are the ones that might be able to really ride that wave.
Right.
So let's start, I guess, with JB Hunt.
Okay.
They seem to be involved in just about everything.
Yeah, they're a very interesting company.
From rail to trucking to even logistics. I mean, they're like a true North American transportation giant.
Yeah, and that's a good way to put it. They really are a powerhouse. I think what's fascinating is that while their stock might look a little bit pricey,
Okay.
at first glance, their price-to-earnings ratio is higher than the industry average, but their cash flow multiple tells a different story.
Hold on, now you're losing me.
Okay.
Cash flow multiple.
Right.
What is that?
So cash flow multiple is a way to assess a company's value
Okay.
by comparing its cash flow to its market value. And in JB Hunt's case, their cash flow multiple is actually lower than the industry average,
Oh, interesting.
which suggests that they're generating a lot of cash flow
Okay.
relative to their size.
So that could mean they're not as overpriced as they might seem.
Exactly.
Okay, so they might be worth a closer look.
Yeah, I think so.
But what about their recent performance? Have they been living up to this, this reputation of being kind of the ultimate multitasker?
In the third quarter of 2024, they actually managed to beat earnings estimates,
Oh, wow.
which is pretty impressive considering there was a slight dip in revenue and operating income.
So they're managing costs effectively, it sounds like?
That's exactly what it suggests, yeah.
Which is always good.
Absolutely.
Especially in a time like this where, who knows what's coming.
Right. Lots of uncertainty.
So what about their dividends? Because, the article we were talking about really emphasizes their potential as a dividend stock.
They have a really strong track record, 21 years
Oh.
of consistently increasing their dividend payments.
That's impressive.
Yeah. And their current yield sits at 0.89% annually.
Okay, so that's not bad at all.
No, not bad at all for income-seeking investors.
But are they just kind of, coasting on past performance?
No, not at all.
Because I was reading, they're making some really interesting strategic moves.
Yeah, there's one in particular that really stands out.
Okay.
They've added 20 hydrogen-powered trucks to their fleet.
Hydrogen.
Uh-huh. And they're primarily going to be used around California ports.
Interesting.
And I think this is significant for a couple of reasons.
Okay.
First of all, California has those really stringent emission regulations.
Right.
So this allows them to comply with that.
Okay.
But secondly, and maybe more importantly, it really positions them as a leader in this growing green transportation market.
Which is, it's only going to get bigger, right?
Absolutely.
Yeah.
California often sets the trends for the rest of the country.
Right.
So it's a smart move for JB Hunt to be ahead of the curve.
Didn't I also read something about them partnering up with Walmart?
You did. That's right. They've teamed up to handle a bigger chunk of Walmart's shipping needs.
So what does that mean for JB Hunt?
Well, for one thing, it guarantees them a very steady stream of business.
Okay.
But it also gives them access to Walmart's incredible infrastructure.
Okay, like what kind of infrastructure are we talking about?
Oh, things like shipping containers, equipment.
Oh, I see.
Things that JB Hunt would otherwise have to invest in themselves.
Right. So it's a pretty savvy move for them.
Absolutely. It's all about strategic partnerships and really solidifying their position in the market.
So all in all, JB Hunt seems like they have a lot going for them.
Yeah.
And they've got strong performance, consistent dividends. They're preparing for the future, both in terms of sustainability and, securing those key partnerships.
Absolutely.
But let's move on to our second company.
Okay.
Knight-Swift.
All right.
They're really the trucking specialists.
That's their bread and butter, one of the biggest trucking companies in all of North America.
Yeah, and their network, I mean, it covers the entire U.S., Mexico, Canada. They do full truckload shipments, LTL.
That's less than truckload.
And even intermodal transport, combining trucking with rail.
Yeah, they've got quite the reach.
They do. But one thing that kind of jumps out at me
Okay.
is their debt levels.
Right.
Seem a little high, especially compared to JB Hunt.
It is something to be mindful of, for sure.
Yeah, how does that affect their risk profile?
Well, their market cap is over $9 billion,
Okay.
and they're currently priced at 10.28 times forward cash flow,
Oh,
which makes them pretty attractive compared to other industrial stocks.
so maybe the debt isn't such a big deal considering their size and their projected cash flow.
Yeah, it seems manageable.
Okay, good. What about their dividends? Are they keeping pace with JB Hunt in that regard?
They're actually a bit higher.
Oh, really?
Yeah, sitting at 1.13%.
Okay.
And they have a really solid track record as well, 20 years of consistent dividend payments.
So another good option potentially for those income-focused investors.
Exactly.
Now, how did Knight-Swift do in the third quarter of 2024?
Well, it was a little bit of a mixed bag. Their net income was down compared to last year,
Okay.
but they still managed to beat analysts' expectations for adjusted earnings per share.
Okay, so not all bad news.
Not all bad news, and their revenue was a little bit shy of projections.
Okay.
But they've given a pretty positive guidance for Q4 earnings per share.
All right, so some bumps in the road, but they seem to be navigating them. Okay.
Yeah.
But, every company, we've been talking about how these companies are making these strategic moves.
Uh-huh.
Are they making any big plays, to kind of shore up their position in this trucking world?
They made a significant move recently.
Correct.
They acquired Dependable Highway Express.
DHE, right?
Yes, DHE.
I remember reading about that.
And this acquisition really gives them a stronger foothold in the LTL market,
Okay.
particularly in California and Nevada, which are really key regions
Right.
for logistics and transportation.
So they're not just buying any company. They're being very targeted in their approach.
Exactly. DHE already has a great network and a solid customer base in those areas.
So they're just kind of plugging right in.
Yeah, it's about tapping into that existing infrastructure and expertise.
That makes sense.
Now, on top of that, they've also partnered with Clean Core Solutions
Okay.
to implement some eco-friendly cleaning technologies in their facilities.
So they're also jumping on the sustainability bandwagon?
It's becoming incredibly important across industries.
I'm noticing a trend here.
And Knight-Swift is clearly recognizing
Yeah.
that it aligns with their environmental goals, but it could also lead to some significant cost savings down the line.
Yeah, you got to think long term.
Absolutely.
So Knight-Swift is playing the acquisition game,
Yes.
really focusing on expanding their LTL operations, and they're getting into the sustainability game as well.
Yeah. They're covering their bases.
But let's wrap up this first part by taking a look at CSX,
Okay.
our rail giant.
The big dog.
What sets them apart? What makes them different from the other two?
Well, CSX operates a massive network, 23 states, mostly connecting those big cities along the East Coast.
Okay.
Their market cap is almost $70 billion,
Wow.
and their forward price-to-cash flow ratio suggests that they might actually be undervalued
That's interesting.
at their current price.
It's a lot of ground to cover, though.
It is, but they seem to be doing it well.
Now, what about their dividends? Are they as reliable as the other two?
They have a 1.33% dividend yield,
Okay.
backed by 2 decades of consistent growth.
All right, so they're checking that box as well.
Absolutely.
Now, I saw something about them venturing into hydrogen-powered locomotives.
Yeah.
Is that just a publicity stunt?
I don't think so.
Or is there some real potential there?
I think there's real potential. This first hydrogen-powered locomotive,
Okay.
which they developed in partnership with Canadian Pacific Kansas City,
Okay.
is a big step toward a greener future for the rail industry.
But is it really feasible on a larger scale, though?
Well, it's still early days
Right.
for the technology.
Yeah.
But think about the potential benefits.
Like what?
Reduced emissions, less reliance on fossil fuels,
Okay.
and potentially even lower operating costs in the long run.
So it's a gamble,
A little bit, yeah.
but a gamble that could potentially pay off big time.
If they could pull it off, it could really change the game.
Yeah, it's a statement that they're serious about innovation
Absolutely.
and about staying ahead of the curve.
Exactly.
Anything else about CSX that you think really stands out?
I think their recent 5-year collective bargaining agreements
Okay.
with their key unions are worth noting.
What's the significance of that?
Well, it promotes workforce stability,
Right.
which is crucial for a company like CSX that relies so heavily on its employees.
They need their people to be happy.
Yeah, they need smooth operations
Uh-huh.
and a content workforce
Yeah.
if they want to capitalize on this growing demand for freight transport.
So they're covering all their bases,
Seems like it.
technology, labor relations, it's all there.
Yeah.
So solid financials, a dependable dividend.
Right.
They're investing in the future.
Yeah.
It seems like they're doing everything right.
Sounds pretty good.
So we've covered a lot of ground in this first part of our deep dive,
We have.
but we've only just scratched the surface.
Right.
We're going to dig deeper into each company's performance, compare their valuations, analyze the potential risks and rewards associated with investing in each one.
Sounds good.
So stay tuned for part 2.
I will.
We'll be right back.
Right after this. Welcome back to our deep dive into the world of transportation stocks.
You know, it's interesting.
Yeah.
We've got these 3 companies,
Yeah.
JB Hunt, Knight-Swift, CSX,
Right.
and they're all in the transportation sector.
Right.
But they really each have their own distinct personality.
They do.
You know?
It's not a one-size-fits-all industry.
No.
And I think understanding those differences
Yeah,
is really key for investors.
absolutely.
So let's revisit their third quarter 2024 performance.
Okay.
We touched on it briefly before,
We did.
but let's dig a little deeper.
Okay.
What were some of the standout details for you?
Well, with JB Hunt, I thought it was really interesting that they managed to beat those earnings expectations, even though their revenue and operating income dipped a little bit.
Right. It shows that they're good at controlling costs.
Yeah.
Which is super important in a volatile market like this.
Absolutely. And their focus on those long-term contracts,
Yeah.
like the one with Walmart.
That's a great example.
I mean, that's a really smart move.
It is. It provides stability,
Yeah.
predictable revenue.
When things get crazy.
Exactly. Which we know they very well could.
Exactly.
Now, Knight-Swift's performance
Yeah.
was a bit more of a roller coaster.
It was.
Their net income was down,
Right.
but they still beat those analysts' expectations
Mm-hmm.
for the adjusted earnings per share.
So how do we make sense of that?
Well, remember, they're in a growth phase.
Okay.
They're going after those acquisitions.
Right.
They want to expand their reach.
Yeah.
And those acquisitions, like Dependable Highway Express,
Uh-huh.
they require upfront investments.
Yeah.
You got to integrate them.
Makes sense.
And
Yep.
that can impact the bottom line.
In the short term.
Yeah, temporarily.
So it's a trade-off.
Exactly.
Short-term pain for long-term gain.
Potentially.
Potentially.
And don't forget about their sustainability efforts.
Right.
Like that Clean Core Solutions partnership
Mm-hmm.
could add some costs initially,
Right.
but it positions them well
Yeah.
for a future where environmental regulations are only going to get stricter.
So they're thinking ahead.
They are. They're playing the long game.
Now, what about CSX?
Okay.
They had that earnings miss.
Right.
But their operating income, their net earnings,
Uh-huh.
and even their volume actually went up.
It did.
So how do we reconcile that?
Well, sometimes a single quarter
Yeah.
doesn't really tell the whole story.
Right.
You got to look at those underlying trends.
The big picture.
Exactly. And with CSX, it seems their core operations are doing well.
Okay.
And their investments in efficiency and technology.
Like those hydrogen locomotives.
Like those hydrogen locomotives.
Like
Exactly.
starting to actually pay off.
Yeah.
So maybe there were just some, outside factors
Right.
that affected them that quarter.
Some unforeseen circumstances.
But overall, the direction seems positive.
Yeah, I think so.
Okay, so it's like judging a company
Uh.
based on one bad day at the office.
Yeah, we all have those.
We do.
It doesn't necessarily define them.
No, it doesn't.
Now let's shift gears a little bit.
Okay.
Talk about valuations.
Okay.
We've thrown around some metrics.
We have.
Price to earnings ratios,
Mm-hmm.
dividend yields.
Right.
But let's take a step back.
All right.
Look at the big picture.
Okay.
How do these companies stack up against each other
Yeah.
in terms of their attractiveness to investors?
Well, I think JB Hunt,
Okay.
with their diverse operations
Right.
and that consistent dividend growth
Mhm.
seems like a pretty solid choice
Yeah.
for investors who are looking for a balanced approach.
A little bit of everything.
Yeah, they offer a mix of growth,
Wow.
reliable income,
Right.
and they seem to be forward-thinking.
Yeah, those hydrogen trucks.
The hydrogen trucks, the Walmart partnership,
It shows they're preparing for the future.
they are.
And while their price to earnings ratio might be a little high
Yeah,
compared to some competitors,
right.
their cash flow generation really supports that.
It does.
Now, Knight-Swift,
Yeah.
with their aggressive acquisition strategy
Mhm.
And that laser focus on expanding that LTL business,
Right.
they seem to be more geared towards rapid growth.
Yeah, they're moving fast.
Yeah, they are.
So they might appeal to those investors with
Well,
a little bit higher risk tolerance.
Right, who are looking for bigger returns.
Yeah, exactly.
And their valuation, if you look at metrics like price to cash flow,
Yeah.
is actually quite attractive.
Yeah.
But their success really hinges on
Right.
being able to integrate those acquisitions
Right.
and navigate this market.
Which could get a little bumpy.
It could.
So higher risk, but potentially higher reward.
Exactly.
And then we have CSX,
Yeah, our steady Eddie.
the reliable workhorse
Yeah.
of the rail industry.
That's a good way to put it.
They've got that massive network,
Huh?
the consistent dividend growth.
Right.
They focus on operational efficiency.
Yeah. They're good at what they do.
I think they make a good option for
Right.
those investors seeking stability,
Yeah.
long-term value.
They're not trying to reinvent the wheel.
No, they're just trying to make it run better.
Exactly. And their commitment to sustainability
Right.
and to labor relations
Yeah,
makes them even more appealing
it does.
to a lot of investors.
So it's interesting how each of their strategies
Uh-huh.
kind of reflects their personalities.
Yeah, almost like different approaches to life.
It is, yeah.
JB Hunt is the balanced one.
Uh-huh.
Knight Swift is the risk taker.
Yeah,
And CSX is the steady and dependable one.
I like that.
And that's why it's so important
Yeah,
to choose investments that align with your own style.
your own risk tolerance.
Exactly.
But, we got to be realistic.
Of course.
No investment is completely risk-free.
That's right.
So what are some of the potential downsides,
Uh.
challenges these companies might face?
Well, we've got to address the elephant in the room.
Yeah.
Those tariffs,
The tariffs.
increased trade tensions,
Right.
disruptions to the global supply chain
Yeah.
could hit all three companies hard,
It could,
even if they're well-managed.
even if they're doing everything right.
They're not immune to those global forces.
And I mean, beyond those macroeconomic factors,
Yeah.
each company has its own, specific risks.
Of course.
JB Hunt, for example.
Yeah.
They're so diversified,
Mm-hmm.
which is good,
Right.
but it also exposes them.
To more potential problems.
Exactly. So if one sector takes a hit, it
Right.
could drag down the whole thing.
Now with Knight Swift,
Yeah.
it's that rapid acquisition strategy.
They're moving so fast.
Yeah, they are.
It's a lot to handle.
It is.
All those new companies, integrating them,
It's complex.
it's not easy.
And if they stumble, it could lead to inefficiencies,
Increased costs.
potentially even debt problems.
And CSX, even though they seem so stable,
Right.
they're not immune either.
Not at all.
I mean, they face competition from other railroads.
For trucking.
From trucking, yeah.
And then there's always the possibility of disruptions,
Yeah, like weather,
whether
accidents, labor disputes,
Yeah, you never know.
even with those agreements in place.
You just never know.
So it's a balancing act for investors,
It is
weighing those potential rewards
against the risks.
and making informed decisions
Exactly.
based on your own goals and risk tolerance.
Your own personal situation.
Exactly.
But I think what's important here
Yeah.
is that we're not looking at these companies in isolation.
Right.
We're considering them within the context
Yeah.
of this potentially volatile market.
Right. The tariffs, the political shifts.
The global economic forces, it's all connected.
And that's what makes this a true deep dive.
I think so too.
We're connecting the dots. We're looking at the big picture.
We're trying to provide our listeners with the insights they need
Yeah.
to make smart decisions.
In this complex world.
It is complex.
So let's move on to part 3,
Okay.
where we'll explore why these companies really matter to investors,
Right.
especially in light of all these potential changes coming in 2025.
Sounds good.
We'll talk about how their strategies align with those changes
Okay.
and why they might be worth considering
Uh-huh.
as part of a well-diversified portfolio. Stay tuned. Welcome back to our deep dive final part.
Part 3.
We've analyzed JB Hunt, Knight Swift,
Right.
CSX,
Yeah.
every which way you can think of.
Absolutely. We've
Mhm.
looked at their financials,
Their performance, their strategies,
their weaknesses, their strengths,
even their potential, vulnerabilities.
trying to get the full picture.
And we've talked about how all of that might play out
Right.
in a market that's, potentially facing tariffs.
Right. Political uncertainty, yeah.
Shifting global trade patterns. It's a lot.
It is a lot to keep track of.
It is.
That's for sure.
But now I think it's time to step back and kind of ask that, big question.
Okay.
Why should investors care about all this?
Yeah. That's the million-dollar question, isn't it?
It is. Why should they be paying attention to these companies?
Well, I think the answer lies in understanding just how vital
Yeah.
transportation is
To everything.
to our daily lives. Pretty much everything we buy
Everything we use
relies on these complex networks.
to get from point A to point B.
Exactly, to get to us.
So investing in these companies is almost like investing in, the backbone of the economy.
You could say that.
It's a bet on the infrastructure that keeps things moving.
Yeah, and with things like, population growth.
Right. E-commerce, the rise of online shopping,
All of that.
global trade routes potentially shifting.
It's only going to increase the demand.
For transportation, for freight.
Yeah.
So there's potential there.
a lot of potential.
For growth, for solid returns.
But you got to be smart about it.
You do.
You can't just ride any wave.
No.
You got to pick the right companies.
The ones that are well managed,
Adaptable.
forward thinking.
Strategic.
And that's where I think our deep dive really comes in.
That's what we've been trying to do.
We've given you the information,
The tools.
the knowledge.
Hopefully to help make those decisions.
Separate the wheat from the chaff.
So let's recap real quick.
Okay.
JB Hunt.
Uh-huh.
They're leveraging that diversification.
Right.
Strategic partnerships.
The Walmart deal.
Knight Swift. They're all about growth.
Acquisitions, rapid expansion. And CSX, they're our steady, reliable rail giant.
Doing what they do best.
But they're all approaching the future differently.
They are. It's fascinating to watch.
And each one has a different set of
Risks and rewards.
for investors.
Absolutely.
So there's no easy answer.
Nope. No one size fits all.
The best choice for you
Right.
depends on you, your goals, your risk tolerance.
How you see the future unfolding.
Exactly.
We've given you the tools.
The information.
Hopefully helped you understand these companies.
See what makes them tick.
A little bit. Yeah.
But this is just the beginning.
Right. It's a starting point.
Investing takes work.
It does.
It takes research
And a willingness to adapt.
to keep learning.
Yeah, absolutely.
So as we wrap up our deep dive,
Okay.
here's a final thought.
Right. I like it.
Considering everything we've talked about,
Tariffs, politics, all of it.
all the potential changes coming.
Consumer demands,
Yeah, all of it.
the whole shebang.
Which of these companies has the most compelling strategy?
And why?
Why do you think they're going to succeed?
What are their strengths?
Their weaknesses?
How adaptable are they?
What's their long-term vision?
Think about it.
Do your research
Make those decisions.
that align with your vision of the future.
That's what it's all about.
Thanks for joining us
It's been a pleasure.
for this deep dive
Always a good time.
into the world of transportation stocks.
Until next time.